Now, we all know that getting rich takes time, dedication, and a solid strategy. That's why I put together this comprehensive guide. 25 ways to become a millionaire in less than 10 years, starting with just $1,000. We'll be covering a range of investment strategies, from the stock market to side hustles, and even some alternative investments. Remember, I'm not a financial advisor, and this isn't financial advice. This is all about sharing what's worked for me and countless others who've achieved financial freedom. So buckle up, grab your notebooks, and let's get started on your journey to becoming a millionaire. Let's kick things off with the cornerstone of wealth building: compound interest. Think of it like a snowball rolling down a hill. It starts small, but as it picks up snow, it gets bigger and bigger. You earn interest on your initial investment, and then that interest earns interest. Over time, this snowball effect really adds up. That's the power of compound interest. Now, here's the thing about compound interest. The earlier you start, the more powerful it becomes. Remember that snowball analogy? The longer it rolls, the bigger it gets. Time is your greatest ally when it comes to building wealth. So don't wait to start investing. Remember, the name of the game is long-term growth. All right, so we've covered the power of compound interest. Now, let's talk about where to put your money to work. And for most people, the answer is simple: low-cost index funds, specifically those that track the S&P 500. Now, you might be wondering, what's the S&P 500? Well, it's like the all-star team of the stock market. It's a basket of 500 of the largest, most successful publicly traded companies in the U.S., like Apple, Amazon, and Google. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all of these companies. The beauty of index funds is that they're incredibly diversified. Instead of trying to pick individual stocks, which is risky and time-consuming, you're spreading your bets across hundreds of companies. This diversification helps to reduce risk, because if one company performs poorly, it's less likely to drag down your entire portfolio. And the best part, historically, the S&P 500 has delivered an average annual return of around 10%. That's right, 10%. Of course, past performance is not indicative of future results, but over the long term, the stock market has consistently trended upwards. Now, when it comes to index funds, it's crucial to choose low-cost options. These are funds with low expense ratios, which are basically the fees you pay to the fund manager. Every dollar you pay in fees is a dollar that's not working for you. Fortunately, there are plenty of low-cost index funds available. For every $10,000 you invest, you're only paying $3 in fees per year. That's a steal compared to some actively managed funds. Studies have shown that most actively managed funds fail to beat the market. Stick with low-cost index funds, especially those tracking the S&P 500. Remember, slow and steady wins the race. All right, let's talk about dividend growth stocks. Now, you might be thinking, dividends? Isn't that what old people invest in? But listen, dividends can be a powerful tool for building wealth. Think of it like this. Dividends are like getting paid to own a piece of a company. You're literally sharing in their profits just for being an investor. When you reinvest those dividends, you're buying more shares. And as you accumulate more shares, you earn even more dividends. It's like a snowball effect. your money growing exponentially. This is the beauty of compounding in action. Remember, time is your greatest asset when it comes to investing. So, how do you find these magical dividend-paying companies? Well, it's all about doing your research. Look for companies with a history of increasing their dividends year after year. This shows that they're profitable and committed to rewarding their shareholders. A good place to start is with established companies in sectors like consumer staples, healthcare, and utilities. These industries tend to be more resilient during economic downturns. Check out their dividend payout ratio. A lower payout ratio is generally better. Look at their debt levels. Stick with companies that have a healthy balance sheet. There are plenty of online resources and stock screeners. Websites like Yahoo Finance, Google Finance, and Robinhood can help you. Just remember, investing always involves some level of risk. Diversify your portfolio and be prepared to hold your investments for the long haul. Now let's talk about real estate. Buying physical property can be expensive and time-consuming. That's where REITs come in. REITs, or real estate investment trusts, let you invest in real estate without owning properties. Think of it like buying a tiny piece of a shopping mall, office building, or apartment complex. They collect rent and distribute profits as dividends. REITs must pay out at least 90% of their taxable income as dividends. That means a steady stream of passive income for you. So, why should you consider adding REITs to your portfolio? They offer diversification beyond traditional stocks and bonds. Real estate can act as a hedge against market volatility. REITs provide high dividends and passive income. Plus, there's potential for long-term capital appreciation. Remember, all investments come with risks. Diversify across sectors and locations. Adding REITs can enhance returns and build a resilient strategy. Let's be real. Relying solely on your 9-to-5 job might not be enough. That's why it's crucial to explore additional income streams. And what better way to do that than by starting a side business? A side hustle doesn't have to consume your life. It can be something you're passionate about. What are you good at? What do you enjoy doing in your free time? Can you turn that passion into a profitable venture? The beauty of a side hustle is that it puts you in the driver's seat. You have the flexibility to set your own hours and choose your clients. Now here's the key to turning your side hustle profits into serious wealth. Reinvestment. Remember the power of compound interest we talked about earlier? The same principle applies here. Reinvest your side hustle profits into income-generating assets like dividend stocks, REITs, or back into your business. You create a snowball effect that can supercharge your wealth-building journey. By combining compound interest with your side hustle income, you'll achieve financial freedom.